Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Tuesday, May 7th, and you're tuned into On Trend, the show designed to keep you on the right side of the trend. So we're going to look at that uptrend in the S&P 500. We're going to see small caps getting a breakout. Healthcare and biotech were bucking the selling pressure yesterday. We'll look at cybersecurity and semiconductors and finish with some stocks to watch. So we're going to start off with the S&P 500 because it represents the base case as far as I'm concerned when analyzing the stock market. Small caps are going to follow the S&P 500. Large cap techs are going to follow the S&P 500. They may follow the S&P 500 to a different degree, like small caps are not yet above their August-September highs, whereas the S&P 500 did exceed those highs, and it is clearly leading the market. But we'll get to small caps in a minute. But as far as the base case, I've looked at a lot of moving average pairs over the years, and I've just decided that for my purposes, the 20-day moving average and the 200-day moving average work as good as any. Sure, you're going to find ones that work better at times and worse at times, and there are all sorts of pairs out there. But in general, once you get a 200-day and a 20-day, you can look at all kinds of itinerations, a 50, 200, you look at a 150, a 250, and performance is not going to differ that much. All right. That's why I don't think you need to go look for the ideal pair. And I've just settled on the 20-day and the 200-day. And that's kind of what makes my base case for the stock market. And you can see that we did have that cross there in the middle of, or actually the latter part of February. And then the breadth indicators turned bullish in the middle part of February, right when we were moving above the 200-day. So been bullish since this February period, mid-February period here for the market, but we're up 25% from that December low there. And so that's a big move without any kind of a pullback, because the biggest pullback that we had was around 3.5% from high to low over a 5-day period. That's not much of a pullback. So the index, the market is entitled to some sort of a pullback. Timing it, of course, is difficult to say the least because a strong uptrend is hard to predict a reversal. But I think the odds favor that happening in the next 3 months, should I say, because the seasonal period is going to turn negative at the end of June. And if you're wondering why I didn't say beginning of May, I am saying the end of May. At the beginning of June, the seasonal period turns bearish. And there's an article from Chart Watchers this weekend where I did some backtest on the best 6-month strategy and found that the best 8-month strategy works even better, and works even better if you add a little market timing. So as far as a pullback, if we get the garden variety decline, we come back to maybe this resistance breakout area around 2,800. And then you can see you've got the rising 200-day. So somewhere in this 2750, 2800 area is where we could get a pullback and maybe some sort of a choppy range. Now there's a potential bearish pattern forming in the S&P 500, but it is a very rare pattern. And also I'm still going to use that 20-day and 200-day to dictate my trading stance as well as market breadth. And this is a weekly chart for the S&P 500. And instead of the 20 and the 200-day, I've got the 4-week and the 40, which is not exactly equal to the 20 and 200-day, but it is equivalent, shall we say. But the potential pattern working here is what they would call a broadening formation. And I'm not using these trend lines as like support and resistance for targets. It's just to show you what is going on here. You had a sharp decline there in the beginning of 2019. Then we had a pretty steady advance to a higher high. And then we had a couple of sharp declines that produced a lower low. And now we've got a pretty strong advance that has produced a higher high. So within the framework of, say, 15, 16 months, a year and a half or less than a year and a half, we've had new highs, 52-week lows, and we've just gone nowhere with a lot of volatility, basically. and that kind of shows a market that is out of control. But again, in order to turn bearish, you would need that 20-day to cross, or that 4-week to cross below that 40-week moving average and some sort of breath signal on the downside. Now, the indicator window shows the 1-week rate of change, and you can see that things start getting out of control again when you get that 1-week rate of change below 3%. That happened in October, and you can see it happened in January. And so things kind of need to settle after that. And they settled pretty quickly after these, few months of volatility in early 2018 and then later in 2018. But if we get a 1 week down that's more than 3%, that would be the early signal that we might want to move to the sidelines and let the dust settle. Now, believe it or not, we had a broadening formation just a few years ago. In fact, in 2014, you can see the S&P 500 was kind of getting out of control there. You had higher highs, but in between that higher high, you had a lower low. There's the 20-day moving average in green and the 200-day in red. So you say, oh man, this is a bearish pattern. We have to watch out for it. Well, keep in mind, it's a very rare pattern, and it isn't always bearish. I think the main thing to watch is this immediate upswing. This is 2014, of course, and of course the 20-day and the 200-day. And if we back this pattern out, I'm just going to extend the date slider there at the bottom, and we'll go out to 2015. Well, you can see we never got a breakdown in the market. So you can see we never got a breakdown in the S&P 500. There's the broadening formation as it was unfolding, and I'm sure it was pointed out by a few technical analysts. But you can see here that we had a normal pullback. It was about 50%, and then we held support based on these lows for a couple of months, and basically kind of a consolidation ended up forming. So you had this big surge, a consolidation, which is perfectly normal after a big surge. The 20-day in green held well above the 200-day, didn't even test it, didn't break the 200-day. So you can see here that even though it was a potential broadening formation, we never got any kind of a reversal. And instead, after a consolidation, we broke out and kind of worked our way forward. So after working our way forward, then we had this big decline in August. And you can see that the S&P 500 broke a clear support level there. You can see the lows going back to late February and the lows from the summer. And we clearly broke support there with that sharp decline. And so that tells you that something was seriously wrong with the market. We got the 20-day moving below the 200-day. And then we got 20-day moving above the 200-day. So we got some whipsaws. And yes, that will happen with moving average signals. And if I go forward here, you can see how this played out. I'm not saying that moving average signals are perfect. There is no such thing as a perfect indicator without whipsaws. You're going to have to be in and out, and hopefully you catch a good move. So you can see here we had that whipsaw at the move above, and then we had a move down, but that one was timely. You can see in late December, you would have been out. You would have avoided this decline. And, maybe you could have gotten in on this breakout here in late February, early March. But then the 20-day moved above the 200-day there in April. But the bottom line is maybe there's a broadening formation now, maybe not. But I'm going to stick with that 20-day and 200-day as far as getting my signals. And I'll put this on today so you can see what it looks like. There we go, May 6th. So, if we're getting a broadening formation, we need to see some sort of confirmation with some sort of breakdown and a signal from the breadth indicators. So the big news is the breakout in IWM, the Russell 2000 small cap ETF, and the strong close yesterday. The breakout was on Friday and the strong close yesterday. Now, overall, we had two patterns working here. You can see you had the big surge, had this flag-like pullback, and then we got the breakout as well as the break above the 200-day. And that 200-day held here, even though it is sloping down. The second pattern at work was a bullish cup with handle. So basically you have the cup forming, then you have the handle, and then rim resistance is marked by the highs that go across that pattern. And you can see we got a break above rim resistance. So this is a bullish continuation pattern. First you need an advance, then you have the consolidation, the cup with handle, and now we've got the breakout, and that is bullish. Now, as far as what to watch going forward, I think we need to watch support here from the lows in April. So if we close below those lows, then that's going to be a negative development for IWM. So now I'm going to look at breadth indicators for the S&P 500, S&P Mid Cap 400, and S&P Small Cap 600. And we're going to look at AD%, which is basically advances minus declines divided by total issues. So advances minus declines, that's net advances, and you divide it by total issues, and that's puts it in percentage terms so you can compare it. I've got a horizontal line there at 80%, plus 80%, and minus 80%. So if you exceed that line on the upside, you have a 90% up day like we had in late December and in January and here in March. And if you exceed it on the downside, then you have a 90% down day like we had here in late March in mid caps and small caps. But we didn't get it in large caps. So I think if you're looking for the first signal that we're going to have a pullback or that correction, then you get that like 90% down day in all three, and especially in the S&P 500, because that signals selling in large caps, which have been leading. Now, what I want to point out here is yesterday, you can see that we had a negative AD% for the S&P 500, minus 45%, negative AD% for the small cap, the mid cap 400, but positive AD% for small caps. So on net, more small caps were up yesterday than down, and that shows leadership. Another noteworthy move yesterday was the strength in healthcare. Healthcare bucked the selling pressure and closed with a small gain of 0.5%. And if we look at this chart here, healthcare has just been going nowhere for quite a while. It's like one big consolidation. These are new high. Well, that's a new high there. Touch the high, new closing high there in December. And we've kind of just been consolidating. And you still have that rising 200-day moving average. And we're back above that rising 200-day moving average. So healthcare is looking promising, but I guess it was the most promising when you were oversold. So RSI was really oversold there in the latter part of April, and that was the third time over the past year that RSI moved below 30 to become oversold. The October signal didn't last very long, and you had a lower low. The December signal was a dandy, and this one is working out so far for healthcare. We also had strength in IBB, in biotechs. And if we look at biotechs, it looked like biotechs were breaking down there, but biotechs are just volatile. And this is an ETF with dozens of moving parts, AKA biotech stocks. So it, even though it has its own support and resistance levels based on people that bought and sold the actual ETF, each individual stock has its own support and resistance level, and sometimes that doesn't always jibe with the support and resistance level on the chart. So, even though IBB, broke this level here, it's rallied back. And what's interesting is you have this late April high, and it's back above this late April high. So over the last 2 weeks, IBB is showing some relative strength and resilience by moving higher and above that late April high. Now, as far as a playable pattern, about the only thing that I see here is, the big advance and some sort of a pullback, and now it looks like we're turning back up. There's not a lot to do as far as, an analysis, I don't think. You could call this a failed support break and a bear trap and a little miniature breakout here. With, if it goes below, closes below 105, then that would be negated. So before I move on to XBI, I just want to highlight the key differences or difference between IBB and XBI. So I went to the iShares website, which is the fund family for the iShares NASDAQ Biotech ETF you see here. And I'm going to look at the holdings. And this one is weighted by the large cap biotech ETFs. And so if you scroll down there, you can see the holdings and the weightings. Now, Celgene is being bought out by Bristol Myers, so it's going to disappear from the holdings here. But you see Gilead is 8.6%. Amgen, which broke down to new lows, is 7.8% roughly. Then you have Biogen, Vertex, Illumina running around 4 to 5%, as well as Alexion. So this one is dominated by the large caps. Now, if we go over to the XBI website, which would be State Street SPDR, it's usspdrs.com. And if you scroll down, you look at the holdings, you see a different group, and you can see the biggest weighting is 1.9%. So it's a more equally weighted ETF. Also, there are like 3 times as many stocks, I believe, in this ETF. So it's a very broad-based ETF with lots of biotech stocks. And you can see the top ones you might not even know. Portola Pharmaceuticals, I've never heard of that one. And I don't think I've heard of Array Biopharma either. But, you know, if you're into biotechs, this is a way to spread the risk by using an ETF. So here's XBI, which is the broader based ETF with relatively equal weightings. And you can see it had a really big move up there from late December until late February. And then had a, consolidation, got hit pretty hard. But overall, I would just view this as a big consolidation after a big advance. And you can see XBI here is perking up because it got to move above that 200-day with a big surge yesterday. Now, the indicator window shows XBI relative to IBB using a ratio chart. And you can see XBI underperformed IBB from July until December, but in 2019, it has been mostly outperforming. A little bit of underperformance here in April and into May now, but overall in 2019, XBI is outperforming IBB, so it might be the preferred vehicle. So I'd recommend for biotech charts or biotech stocks and ETFs at least that you also consider looking at the weekly chart to get some perspective and filter out some of the noise. And on the left of every sharp chart, you have your chart style buttons. And I've got a button for a weekly setup that I like, or chart setup. And I just click that button and I will get a weekly chart for XBI. And we can see that, we did have a breakdown there in October. And since then, we've had a breakout, if you will, and a break above the 40-week, which is falling. We moved below the 40-week, then back above it. But I think that this is a big surge and a pullback. We'll see what happens. It's like this is what you have to watch out for from the bearish perspective, is that you had a sharp decline. And if we move below, say, last week's low, then that's going to be a bearish development for XBI. But right now, when I look at it, I can see that RSI is right at the 50 line. So it's just above 50. That's net bullish. We did have a new high here. So that's the only thing. If we move below last week's low, then I would negate what looks like to be a bullish setup in XBI. Now we'll look at some stocks that are part of the healthcare sector, and some are even in the biotech ETF. And the first one is Abbott Labs, and this has been one of the stronger ones. You can see when all the healthcare stocks were hit there in the middle part of April, Abbott declined with the group, and RSI moved below 30 for the first time in over a year. And then Abbott got almost an immediate bounce. And since that bounce, it's kind of consolidated a little bit with what may be a pennant or a flag, and a breakout there would be bullish, but it's very close to a 52-week high. It's well above the rising 200-day moving average and clearly in a long-term uptrend. Now, the next one is Alexion, and this is part of the biotech group. And what we can see here is a possible Head and Shoulders of the continuation variety. You can see it's not exactly symmetrical. There's a deeper dip, but there's clearly some sort of consolidation going on within an uptrend, and a breakout there would be bullish. And if I look shorter term, you can see there's a lot of support there around that 200-day, and we got a nice surge and then a consolidation, kind of like a flag-like consolidation here, and a breakout there would be bullish for Alexion. Then moving down, we have Arena Pharmaceuticals, and this one had one of the bigger moves over the last 3 days. But we can see overall there's kind of like a wedge correction. You had a breakout from this zone here, and the breakout zone turned into support. There you have the 200-day also marking support. So after a big surge, a correction, it looks like we're breaking out to continue higher. And these are clearly not for the faint at heart because they are volatile stocks. Now, before I go on to Gilead, I want to show Johnson & Johnson because the next two I'm going to look at weekly charts here. Julius highlighted Johnson & Johnson in his RRG charts last week. Basically, you have this kind of consolidation and a breakout. And it held up the best during that April decline when the healthcare stocks were getting hit hard. Johnson & Johnson held above the rising 200-day and got a breakout, so I would suspect it's going to hit new highs fairly soon. Now, the last two are stocks that I think look better on weekly charts. Here you can see a choppy uptrend, basically, but I'm going to go ahead and put this on the Sharp Chart workbench, and I'm going to add my weekly template there. And if we look at this chart for Vertex, which I've highlighted before, basically it's gone nowhere for over a year, almost 2 years there. You can see it first got above 170 in 2017, 2018, and now it's back near that 170 area. Had a dip below about 4 weeks ago. But I still think you look at this chart, there's an upward trajectory of higher highs and higher lows. So this is clearly a rising channel. We're near the lower end of that channel, firming after that sharp decline. So a little breakout there would be bullish for Vertex. And then the other one I wanted to show on a weekly chart is Gilead Sciences. And this one has been rather frustrating. You can see that it's been in a choppy trading range for quite a while. And that trading range actually goes back to 2017. So it's kind of gone nowhere. But look at all that support around 60. A lot of support there. Yeah, you can see we got lower highs working here, but we finally got a higher low there from December to April. And we got this big surge off support. So Gilead might be one to watch for a potential breakout and move back up to that upper part of the range in the low 80s. Now, looking within the technology sector, I was noticing that the cybersecurity ETF continues to act well. This is Hack, and we can see that it got the breakout there with the move above these October, November, December highs and above the 200-day. And the 200-day has been rising pretty much all year in 2019. And price is well above that 200-day. But what is impressive here is you get this surge, and instead of moving sideways or correcting, you get sustained buying pressure with higher highs and higher lows here. So this one continues to act well. You can see RSI has not been really barely even below 50 in 2019, and certainly not below 40. So it's been strong as far as momentum in that the pullbacks have been limited. Now, when we look at the semiconductor ETF, the SOX, which is the semiconductor iShares, we can see that it has been leading since the latter part of December with just a massive move from 145 to 215. And you had a couple of small pullbacks along the way. And now we've got what could be a pennant consolidation. Now, I'll be the first to admit that playing a bullish continuation pattern after this massive advance is very tricky because you could get a breakout and then a deeper pullback, because we do have that where the seasonality turns negative when we get into June, July, August, and September. So I think you have to be pretty tactical at this stage. But it'd be perfectly normal after this big advance for the stocks to correct back towards that breakout zone, which would amount to just a 38% retracement of the big move. And that could be an opportunity to enter at a lower risk. So looking within the cybersecurity space, we can see Palo Alto Networks continues to act well. It's one of the leaders in cybersecurity. And first, you had the breakout there, the move above the 200-day, and then the gap and the 52-week high. And since then, we've been consolidating with a triangle, and it looks like we're breaking out of that triangle and ready to continue higher. And you can see RSI was overbought here in January and February, and then it pulled back to that 40-50 zone, which acts as support, and we're bouncing off. So momentum is still bullish for Palo Alto. Here is Proof Point, and it is holding its breakout. You can see that it had a bit of a flag and it broke out, and this breakout zone is acting as support. It's a bit of a volatile one, but I'd watch support there in that 115 area and reevaluate on a move below that level. And then the next one is one of the more volatile ones because you can see there's that 76% advance, but a long correction. We're firming here in March and April. It had a good day yesterday considering, but we need to get a breakout there at 20 to reverse that downtrend and target a move to new highs. And just a little programming note, you can see On Trend on Stock Charts TV. There's the page for Stock Charts TV. If you scroll down there, you can see the schedule, and On Trend shows at 10:30 a.m. Eastern Time. And then we have Market Watchers Live with Tom and Aaron, of course. And then On Trend will repeat again at 7:30 p.m. But even if you miss the broadcast episode, you can always go to our archives on YouTube. There's a link on these for the replays that you can see on our YouTube channel. And if you scroll down, there you will see On Trend with yours truly. And you can click on View the Full Playlist. And of note, I did a video, the best 6 months is really the best 8 months. And I did some back testing to show how you can improve your overall market timing using that 6-8 month strategy plus a moving average. All right, and finally, I want to show on semiconductor, which I think has a bullish chart configuration and could be poised to move higher. First of all, we can see the stock forming some sort of a bottom with two lows in that 15-16 area. And then we had a breakout to confirm that. And after moving, pretty good move from late December to early February, and then had a pullback, and that's a throwback to the breakout zone. So broken resistance turns into support. We got a nice surge off support, and now we're kind of hitting resistance there just below 24. Maybe this is a small inverse continuation head and shoulders. I just think the bigger trend is up. This is a little consolidation, and I would watch for a breakout and a continuation higher. And you can see RSI is in its bull range. And that concludes this edition of On Trend. Thank you very much for tuning in, and remember to stay on the right side of the trend. Have a great day.